Just gonna start by welcoming everyone. I'm Levent Karamol, Project Director at Community-Led Housing London. We work with people all over London who are coming together to take a leading and lasting role in delivering affordable and sustainable homes. Community-led housing isn't a particular tenure or a particular design typology. It doesn't necessarily mean communities take on all of the development, but it is about control and empowerment on the decisions that matter to those communities, to people themselves. We've organised Doing Housing Differently as a series of discussions to explore some of the challenges we've seen in delivering community-led housing projects and also doing this at scale. But we also think that some of the opportunities for the wider housing and development sector could learn from or incorporate some of the principles underpinning community-led housing in the way they do development or manage housing might be relevant. So there'll be sessions coming up, particularly tomorrow and Wednesday, that'll kind of focus on that. Today's session is probably a little more focused where communities are trying to do development themselves or looking at ownership. So one of those particular challenges is around finance, and a lot of the community-led housing groups we work with are undercapitalized. That means they don't have a lot of money or assets to begin with. And while there are senior lenders out there who will potentially lend the majority of the funding, there's often a gap which groups have to scrabble around to pull together from various sources. Or it's a case of persuading a local authority to let them use their land as the equity portion that potentially puts that site at risk, as there's very little out there in terms of who's taking the risk. So that's a topic we really wanted to focus in on and explore today. We are very lucky to have an amazing panel to help us explore that and how we might create the conditions to possibly make fully funding community-led housing schemes a lot simpler and avoid people kind of scrabbling around for that missing gap. I'm going to hand over to our chair for this afternoon, Dinah Roake, who is currently Operations Director at RUSS. And she's been involved in other CLT projects in the past, and she's also worked at the Homes and Communities Agency. So I suppose before you introduce the panelists, Dinah, I wanted to ask if you might want to kind of elaborate on the issue that I've been talking about, and maybe in your own words, a bit more detail on what the issues are, and possibly if you have any initial ideas on what the different approaches to addressing them might be. Or maybe that's something we can pick up later in the discussion. So I'm going to hand over to you.
Okay. Hopefully everyone can hear me. If you can't, then put a note in the chat and I'm sure we'll get that picked up. So yeah, I think picking up on my previous experience with Homes and Communities Agency and what's now Homes England, that when the Home Building Fund was established to support small builders, not necessarily linked to community-led housing, there was a very, very simple formula that was used a lot of the time, which looked at organisations' creditworthiness, by that their sort of financial standing and perceived risk, and also collateralisation, the security on any loan. And obviously one key thing in terms of the security on a loan is if you own some land or have some kind of security yourselves over some land. So I think one of the key things in terms of identifying the funding issues for RUSS when I became involved just over 2 years ago, which I can see on the list. I think John Broom has joined us, so he was very heavily involved in all of that back then, was actually identifying what the land value was, and whether or not RUSS needed to raise money to purchase land, or whether RUSS could somehow secure land through, which is what actually happened, through a sale and development agreement, which allowed the land to then be used as security in due course, to allow then a conversation with lenders to be established. And I think I've sort of used the phrase previously about becoming investor ready. RUSS actually was very successful in raising relatively quite generous bits of pre-development funding that helped it with that investor readiness, identifying how to present things in a way to people like Mark on the call here, so that the numbers were put together in a way that you can present things in so many different ways, but presenting them in a way that makes sense to an investor, whether that's the bank, whether that's in our case the GLA, and also social investors who will be looking for slightly different outcomes, I guess, but they will also generally, because their money is less secured than the banks, would generally be looking to charge a higher interest rate than the bank, but they are there to sort of fill that, as you're saying, that gap, that equity gap, which fills the space between what the bank feels comfortable to do and what the full costs going into development end up being. So that's really, I suppose, framing it from RUSS's perspective. I think it's probably worth also adding that we got some professional handholding to do that, which again we raised. There were social investment grant funds to help us to pay for those pieces of work as well in RUSS. I think I will wrap up, but I might contribute later on in terms of the way in which we do our questioning. I have got some illustrations of the way in which the Home Building Fund did do that very, very simple calculation of increasing the interest rate as you became more risky in terms of credit or collateral, and in the terminology they used. If anyone wants to see that, we can talk about that later maybe. So we've sort of had a chat about the order, and we're basically going to go. Mark Ogden is from Triodos Bank is going to talk to us about the perspectives from the sort of investor bank side of things, and then Liz Corrado is going to talk to us about a report that was prepared for Power to Change and the sort of research that was done for that. We're then going to hear from Louise from Bevan Brittan on the sort of legal, what you need to do to put it all in place, and then hopefully Jonathan Schifferes from the GLA is going to wrap it all up with how the public sector can introduce an entrepreneurial support framework that will make this all happen. So I'm going to hand over to Mark Ogden.
Good afternoon, everybody. Nice to kind of see you all. It's a bit less daunting actually doing it like this rather than standing in front of 70 odd people in a room. But I suppose the other slightly daunting thing is, and I'm sure other people have got the same problem, I've got 2 dogs in the office with me, so if there's any strange noises or any heads pop up, it's them, not me, honest. I was asked to contribute to this meeting, and I think very briefly, just an idea about Triodos and our involvement. We have been lending in the UK for over 25 years and have been actively involved in community-led housing since probably about 2009, when I did my first community land trust funding project, which was one down in Devon. And things have moved on a lot since then, and we've kind of matured with it as the market has matured as well. So the first part of my little chat was really about where the market is, or the sector, and really our activity in it. So at the moment, it's still the whole community-led housing sector is a sector that we are actively funding at the moment. We've got somewhere around £20 million of funding, either already drawn, projects that we've offered on that are going through the legal process, ones like RUSS, which we won't talk about, and other projects where I'm at quite advanced stage of sort of discussion, and probably hopefully be issuing heads of terms, which is kind of a first step in that whole approval of funding process. And I think there's several things about really the sector at the moment. I mean, demand is just continuing. And I think there's two parts to that. I think the way the economy is going, I think the demand for affordable housing is going to continue to increase as people, their incomes drop. The ability to actually purchase or rent a property in the open market is going to be more and more difficult. I think the other thing that's really is coming across now is that there's more and more CLTs that are delivering, and that just builds confidence both in other CLTs but also with local authorities and other investors. And the other thing also is the projects I'm seeing are more and more ambitious all the time. So you go back a few years and probably 5-6 units was probably the norm, and now 20, 30, I'm even talking to one that they're looking at 50 in a couple of different stages. So it really is quite amazing that ambition that's now coming through. And I think the understanding from local authorities that communities can actually deliver on this is really helping to drive things forward. I think the thing that really would help the sector is actually more funders, and I know that's kind of cut my own throat a little bit, and obviously CAF and Ecology, I think we're probably the three main funders in the sector, but I think it would be good to get more people involved. But I think part of that is to, I hate to use the word, try and mainstream it a little bit more. So try and get projects a little bit more standardised if you can. And I know that's very difficult, and I don't think every single project I look at is different. But I think the more that we can drive those sort of similarities, I'm sure that's going to help in the sector as a whole and getting more funding into it. As Dinah's mentioned, I think one of the biggest issues really is the gap between what a senior funder like Triodos will provide in funding and actually what you need to complete a project. And certainly grants, Community Housing Fund or the GLA now, that's certainly moved a lot of projects forward that I think will probably have died a death. And obviously at the moment there's problems with the Homes England delivery on the Community Housing Fund. Hopefully that might be clearer in the next couple of months or so. But the GLA obviously are still in a position where they've got grant money to make available. I think one of the things also is the way that the land's transferred, and that's been touched on I think already. And certainly I think some of the more successful projects are where land is being transferred at heavily discounted or even nil value by local authorities. And it's not quite a leap of faith anymore. I think there are ways to demonstrate to local authorities that there is the value is not necessarily just in the monetary sense. There is a social value, and I know that Bristol City Council have developed a social value calculator which can help demonstrate that value and hopefully give confidence to the local authority. And then there's all sorts of other bits and pieces, and again Dinah knows mortgaging in possession clauses and that kind of thing, but what that does is it gives the bank the ability to lend against a higher value, but also it gives confidence to the local authority that a big bad bank is not going to come in and at the first opportunity sell everything and make a huge profit. So there's a twin thing there. One thing that's not been mentioned I don't think is sweat equity, and again that's something that RUSS has certainly helped. So sweat equity is effective. You're getting building work done kind of for free, so you're not actually having to have funding for it. It's being done by the people who are actually going to live in the units. But from a bank's perspective, it has value, so it adds to the value that the bank is lending against without the cost of actually paying the contractor to deliver it. Junior debt is another way of filling the gap, and again that's been mentioned, and the people from CAF are providers of that, and there are a few others that are around that can help with that side of things. So it just tops up the amount that a senior lender will provide. The other one that's interesting, but I've not actually seen anything really delivered yet, is community share offers. There's been quite a few CLTs that have kind of looked at it, but I've not really seen a particularly successful one yet, or certainly not one of any scale. And I think that's an avenue that could be looked at. And I know that my colleagues in our corporate finance side of things are looking at that to see if there's anything that they can do in that space. And the other thing that I think is going to come in later, I'm just looking at the agenda there, is how would banks, senior lenders, lend more than they will do at the moment. So typically we kind of top out at about 70% of the overall cost, maybe a little bit less. So you have got a gap there. One of my thoughts really was some form of comfort for a bank to go further than the normal amount. And potentially one of those is some form of guarantee. And I know that's been talked about a couple of times with a GLA, potentially providing a guarantee to the bank. Not quite sure. Oh, there's a look of horror on Jonathan's face there, but I know that's been mooted. And I know a few of the local authorities are also looking at doing it. And from the local authorities' perspective, yes, there's a liability, but it's not actually a cash liability as such. So there's an attraction there. From the bank's perspective, it's kind of blue chip lending really, because you've got that kind of security that, let's face it, if that goes horribly wrong, I think we've all got things to worry about. So I think there's lots of things that potentially we can be looking at on the equity gap side of things. And I think more and more work is going on around those to get a blend of them, hopefully, that will help drive things forward. I think that's probably me. Okay.
That's really, really helpful. Lots and lots of food for thought there, Mark, and we'll definitely come back, I think, to that underwriting one, which is quite innovative and would need a lot of us to do a lot more thinking. Yeah. So next, I'm going to ask Liz Corrado to introduce herself and speak. Is that okay?
Mm-hmm. Good afternoon, everybody. My name's Liz Corrado. Funded very generously by the Nationwide Foundation and Power to Change, three of us came together to look at the subject of land and land acquisition and support for land acquisition for community-led housing groups. We completed a study over a period of 18 months where we spent lots of time out in different parts of the UK discussing the challenges for groups for acquiring land. And the purpose of our study, we had a hypothesis that to be able to structure an investment vehicle that would provide upfront funding to groups for the purchase of land. So the three of us had been watching, and I was an employee at one point of Power to Change, and we had observed, of course, the rather generous government funding that had come to bear, but that still really wasn't addressing the barrier, the largest, or we felt was the largest barrier to, or one of the big barriers to community-led groups, which is the upfront purchase of land. And whilst many to date have been able to rely on a benevolent landowner willing to transfer the land for free or on favourable terms, or indeed the ability to rely on grant funding, or finally to partner with a developer or a housing association. We began to see there are a number who would prefer not to go that route, and that also that grant funding was becoming less available, and indeed the amount of land being transferred on favourable terms certainly was reducing. So, and there are other groups who wanted to capture the full benefit of ownership of the development without being obliged to partner and continue to partner with a development group. We also wanted to help and see if we could explore the ways we could strengthen negotiating hand of those groups to be able to be sure that there was an availability of funding to be able to acquire the land. So in all contexts, we were trying to address the barrier of acquiring land experienced by groups in different ways. Lack of funding, lack of availability of land to be transferred at the appropriate rates, the lack of negotiation leverage, the less willingness to become an RP, which would have otherwise allowed them to have access to perhaps government funding. And indeed, over time, at least our observation at that time, which is a good bit of time ago, rather less interest on the housing part of housing associations to even partner with community groups to help them on their development journey or your development journey. So we, with the support of a number of sector partners, as we call them, around the country, 6 in fact, we devised, and again in conversations with people like Mark, who's just spoken, so we spoke to the investors to understand really what their interest would be to see that a funding vehicle might address what we felt to be the equity gap up front and the lack of capitalisation on part of the whole sector to really bring some equity into a project. And so we devised a £10 million fund. We saw that it needed a good bit of first loss capital up front in the event that land purchases were not as successful and the groups were unable to continue with the development of those projects, and 7 million of capital that would be on a repayable basis. So a blended funding structure where the risk was shared between the fund and the groups. So the funding would be provided as on a loan, and a loan to the project and a loan to the group. And that loan would be repayable at the end of development. And there were certain and several conditions outlined in that funding structure that would mean that the fund would take a subordinated position to the main lender as the fund and the group moved into the development phase, which is of course is a barrier where most lenders want to still take first charge over the project. And secondly, the group or the funding structure recognised the risk and wished to share that risk with the groups of, for whatever reason, that group being unable to proceed with developing the land. So under certain terms and conditions, the fund would take the land back and try to resell it and share the risk with the group, if not take a large part of that risk. There are lots more details to that fund. We were unsuccessful in launching it, certainly unsuccessful, not, I think, because the idea is lacking in validity, but it does require a good chunk of first loss capital and therefore the kind of funder who's prepared to put that funding up front. I think there's also, and was some doubt on the part of others, that the economics of community-led housing projects don't necessarily stack up if a need is there to fund the acquisition of land at full value. We heard differing views, particularly amongst those groups who were particularly keen to take on competitively priced land that was part of auctions and be more proactive rather than reactive in taking plots of land that were made available rather than plots of land they wanted to seek out. Anyway, I'm hoping that's helpful. We remain hopeful that in time, maybe there will be appetite, particularly on the part of those with rather deep pockets, to provide that appropriate risk capital to get a funding vehicle in place.
Thank you very much, Liz. Again, a lot of questions that we need to cover later on. I'm going to move us on to Louise, who's going to tell us legally how we're going to make it all happen.
Thanks, Dinah. And actually, I'm not sure I can give you a nice, neat legal answer, I'm afraid. So let's start with the bad news. And I also actually, just sort of as a bit of background from my point of view, I'm not a community land trust specialist. So start with that point, but I am a social housing finance specialist. So I've done a huge amount of social housing finance in my career, so for the last 25 years. And what I thought I would do really was to look at some of the structures I've come across and to see if there's anything that might be useful as a read across into community land trusts. as I said, I'm a finance lawyer. I started life at Clifford Chance, which is one of the largest law firms in the world, or certainly was at the time, and not necessarily someone you'd expect to focus on social housing. But we acted for a lot of the banks involved at the very start of the housing association journey, and the private funding of it, so around 1988. And so it's interesting, Mark just saying just now about sort of mainstreaming some of this. I think that was the point at which really private debt came in to sort of the housing association world, and perhaps there's something to be learnt there. I then moved to a much smaller firm focusing on social housing, did a lot of work for borrowing, for borrowers, for registered providers and housing associations. And then just at the start of lockdown, I decided I'd move. Well, I decided before lockdown, and then in lockdown moved firms to Bevan, Brittan. They've got a very strong housing team. They look at housing management, governance, development. They do a lot of the development work. And my focus is to build a banking team. But the other interesting thing about Bevan Brittan is that they also have a lot of local authority clients. They work for almost all of the local authorities up and down the country, and the National Health Service. And I think there's a lot of, again, in terms of how to make CLTs work, I think there's an awful lot of sort of looking at across at where there are crossovers and how we can bring in that expertise and how we can work together more. The other thing perhaps to mention, and really part of the reason I think I sort of was invited along today, is that I have a personal interest at the moment in CLTs. So we are just setting one up in my local area with the help of CLH London as well. And so, I genuinely believe that they can make a difference for housing, for communities and for individuals, and just want to see how we can fund it. So, getting the funding right has now become much more of a personal sort of drive as well. So I thought I would look at, the question was guaranteeing and underwriting. How do we underwrite this equity gap? So, just looking at who can give that guarantee or underwriting, who has given it in the past, and I suppose, again, going back to my sort of work with housing associations, I sort of thought about the fact that actually right at the very beginning, housing associations were also startup vehicles. They had no money, they had no assets. They were effectively, most of them were set up, or a lot of them were set up either by benefactors who gave them money, or from council transfers. So say in the 1980s, there was huge amounts, sort of thousands of properties transferred over from councils to individual housing associations. So they had large amounts of assets at that point, and they got those transfers at lower value. And it worked really because of government grants. But it also worked because councils were prepared to stand behind the land that they were transferring over, the properties that they were transferring over, giving certain warranties, which were then relied upon by the banks. And I think that again, that's sort of just how can local authorities help around this? It's not just maybe about transferring the land over, but also can they give some kind of additional comfort to the lenders about the land or the properties that are coming over? Obviously, I think at the time grant levels were about 80% for social housing, which would just I don't think anyone realized quite how lucky they were at the time. But it didn't always work. So one of the other things I was thinking about was that actually in Wales, quite a lot of the transfers that they did required what they called gap funding. So the Welsh government had to put funds in because actually the value of the properties they were transferring over was so low that they were effectively paying the housing associations to take them on. And I'm not sure that necessarily helps us here, but it is just, I think, an example of how actually local authorities can become involved if they need to. The other sort of thing I was then thinking about was, okay, well, grant was great. What happened when grant dropped away? Who dealt with that? Who can deal with that? And central government effectively then, in a way, sort of stepped in. I mean, not fully. And a lot of the housing associations at that point and since have become very large companies. Some are FTSE 100 equivalents, and they raise a lot of debt against existing assets, and that's the difference, at very low cost. But there's still quite a lot of small and medium housing associations that need support. So around about 2013, the government sought to, that's effectively when the grant funding reduced. And what they did then was put in place the Affordable Homes Guarantee Scheme. And that was about £3 billion programme. I think in the end, only about 2 billion was utilised, but it effectively used government's credit strength to provide an initial guarantee for bondholders. So it was looking to go out to the bondholders, so not the likes of Triodos or others, but actually looking at sort of pension funds, long-term investors, and trying to bring them into the sector, and against government, sort of the strength of the government, and that's, that was a very successful scheme, even if it wasn't fully utilised. They've just launched another £3 billion Affordable Homes Guarantee Scheme, which is due to start in the next few months, I think. But again, it required housing associations who had their assets usually. So they already had this property, this land, and they were using that to give the security. And as we've already heard, that isn't necessarily the case. At the same time, there was a government scheme for PRS Guarantee Scheme. So effectively looking at supporting growth in the market rent sector. And this was a similar but slightly different scheme, and this was aimed at small to medium-sized developers wanting to build market rented properties and trying to build up, this kind of area. And they don't have assets, so they're much more similar to CLTs. As a startup scenario, they've probably got more of a credit history, and therefore in some ways it's easier to become credit or investor ready, as we've talked about, but not always. And they certainly didn't have the assets. So this worked, the way that scheme worked, the government effectively guaranteed the takeout debt, so not the funding for the development. So it dealt with the debt at the end of the day, and it would take out the development finance. But what they would do is provide a letter of comfort to the lenders. So it provided some additional comfort to the lenders that there would be somebody to take on this debt at the end of the day. And I just, I wonder whether that's worth exploring to see whether there's something similar that could be done to sort of close that funding gap a little bit. A very brief, I suppose, and I just worth mentioning from a legal point of view, government mostly don't have state aid issues with giving guarantees, so it's quite an effective way for them to support industries that are needing to sort of grow, that are in their sort of infancy. So looked at government. The other thing, and again, just sort of coming from my background, and I know that others have mentioned it, is how much can CLTs be looking to housing associations? There's obviously working with them as developers or partnering. Could they give a guarantee? Could they underwrite a CLT? It would seem a relatively easy solution. They've got assets, they've got a social purpose, there's an alignment of interests, building housing in the community. But sadly, I think it probably won't work for them to do this guarantee or underwriting idea, because most of them are charities, most of them are regulated, and for that reason most of them can't or won't give guarantees. So I think that the conversation around guaranteeing or underwriting is unlikely to go very far with housing associations. What I do think is that there are ways for them to work together, and I think that's an area that probably is ripe for exploration in terms of whether it's using development expertise, whether it's then putting some equity or some loan into a CLT, and that is slightly easier for them to do than giving a guarantee, interestingly enough, from a legal point of view. And I think that there's a lot about at the moment around sort of housing associations looking to support their communities and becoming even more involved in communities and placemaking, and they have to demonstrate to their funders that they have a social and sustainable and environmental impact, and that's important, becoming more and more important for them. And part of that could be arguably becoming involved in sort of placemaking with their local CLT. And there are I think there are lots of other things to think about. The one other thing I just thought worth mentioning is the fact that, you know, in the general scheme of things, the amount of money being borrowed is quite small. So the amount of money being borrowed, if you are a CLT setting up, the amount of money being borrowed is quite large. If you are a fund or an investor, the amount of money is relatively small in the bigger scheme of things. So you've got to shout quite loudly to get your bit of the pot, if you like. And I just wondered if there's some scope for aggregating, as we would call it. So again, in the housing association sector, they've been very successful in aggregating that requirement. There's things like THFC, so well, the Housing Corporation originally, but THFC. There's More Homes is a new one that's currently actually it's owned by housing associations, and they raise debt for housing associations. I was involved in a deal for M&G investment where they lent to 17 Welsh housing associations all in one go. So the total amount was 156 million, but some of the loans were 1.5 million or around about that level, and some of them were 20 million. And that worked for two reasons, really. One is that M&G looked at that as a package, so their credit analysis was against the package. But they also had some government grant from the Welsh government. But again, it's leveraging off that grant as much as possible in order to deliver as much funding as possible. And the only other thing I think to say on that kind of thing, these aggregator idea, is that from a legal point of view, it's not about trying to get CLTs to put up their assets for someone else, because that's not a good thing. You don't want, from a legal point of view, to be using assets from one CLT to another CLT, but it's about how to benefit from taking an aggregated approach to it and trying to increase the demands and sort of I suppose tell the story as well. And I think there's quite a lot to be said about the sort of the real drive at the moment I'm seeing from institutional investors around sustainable investment, but also becoming investor ready and selling your story, being able to explain that to your investors. Sorry, I think that's probably about enough for me from now. We can talk about community shares. There's a little bit of work going around community bonds. There's something quite interesting around that. We can come back to that maybe later.
That's absolutely fantastic, Louise. Thank you very much. I mean, I think, you know, we those of us that have been working alongside co-ops and co-housing groups are, you know, very conscious, particularly with the established co-ops, of the issues of them looking to use their existing assets as collateral. But the point you just raised in terms of they don't want to then put, as individuals, they are anxious about putting their own homes at risk. And I know I'm going to give a little bit of a plug for a later session in the Doing Housing Differently suite of events that will be coming up. I think on Wednesday, Lev, is that right? Yeah, okay. Right. So Wednesday afternoon. Okay, fantastic. So I'm now going to move us straight into Jonathan to give us either his personal or hopefully the GLA's view on all of this. Thank you.
Thanks, Dinah, and thanks to everyone. Yeah, inevitably it'll be a bit of both, right? It'll be my institutional formal view, shaded and coloured by kind of my own experience. So just a tiny bit about me is I've tried to, in my career, sit on different sides of the table every few years. So I started as a planning consultant, trying to get big housing developments built, mostly for private sector organisations. I then worked in a kind of policy influence think tank research world, doing social research projects, worked with a lot of housing associations, including Rochdale Borough-wide Housing, which is a cooperative housing association, and kind of came across the world of community housing several times. And like many of you, I've tried to get money off Nationwide Foundation as well to kickstart some work we were wanting to do when I was at the RSA. I've worked at the Greater London Authority, the GLA, for 2 years now, on brand with my map of London behind me in the Home Office here. So I work in the area teams. So we organise ourselves so that we each kind of take care of a corner of London and a couple of boroughs per officer. So I've worked with Lambeth, with Lewisham, and now with Harrow and Hammersmith and Fulham. So I've come across a number of community groups in that work, and I've also got a familiarity across the breadth of the GLA's different funding streams. So I just wanted to run you through kind of my perspectives after 2 years in the public sector on working with the community-led housing sector. and also reflect on some of what we've heard already. I mean, well done to Lev and the team at the Community-Led Housing Hub for London for bringing together this week of events. It's awesome to have so much kind of brain power in one place, and I'm already learning loads and making loads of notes, so I'm sure everyone else is as well. I think the first thing to say is, it struck me really early on at the GLA that we definitely recognise that given the scale of London's housing challenge, we're only going to start to get closer to the level of housing we need and the level of genuinely affordable homes we need if we start engaging a wider group of delivery vehicles, delivery agents, partner organisations. You know, it's not just going to be through the existing private sector developers and the existing housing associations, as wonderful as they are. We're going to need more. We need councils building more, and we need community groups and community-led housing projects delivering part of that package. And I think there are clearly certain projects that lend themselves to community-led housing in terms of the scale and nature of the site and the available kind of resources, expertise, sweat equity in those neighbourhoods. So we know that we need innovation. I'd say it's worth bearing in mind when you think about what the GLA is trying to do. You know, our guiding star under the current mayor is we want to accelerate an uplift in the delivery of genuinely affordable homes. And the way we get that, the means can be figured out, but it always has to kind of come back to that. And I think, you know, that acceleration point is key, and probably being at my most negative, I'd feel like the challenge for community-led housing groups is to prove to their funders and to their other partners that that route to development won't necessarily slow down development. Now that's tough because good projects take time, and there's wider value that comes from community-led housing above and beyond the units, the homes themselves. But I think it's important to recognise that the GLA's guiding star is about speed as well as scale of delivering affordable housing. So we have several tools at our disposal that can help us to accelerate housing, and particularly devote those resources to community-led housing groups to do that, to be those vehicles of delivery and change. We don't have all the tools that we want, and we also often it feels like when we've got those tools, we are operating within constraints that have been handed down to us from our funders, so from central government. Central government provides a lot of money to the GLA. Indeed, most of the housing and land money in the GLA is from central government, and quite understandably, quite properly comes with constraints and restrictions on what we can use it for. So in the old affordable homes programme, we carved out a bit of room to do some innovative funding, which we called the Innovation Fund, and a couple of projects came through that. We've also got a big pot of money called the Land Fund, which I can post links to in the chat in a minute. That is £476 million of funding that we can really use for grant or loan. And we funded a number of developers and housing associations through that. It tends to be, as Louise was alluding to, from a funder's point of view, we want big ticket items, and it'll be familiar to everyone. You know, it's pretty much it's often the same level of effort to get £1 million approved as to get £1 billion approved, believe it or not. The approvals pathways, you know, the level of scrutiny isn't necessarily proportionate. So aggregating is a really interesting concept and really key theme, and I'd be interested to hear more about that. We've got the Community Housing Fund obviously devolved, so that's £38 million from central government, and we've got the London CLT that's access funding through that, RUSS is access funding, and Naked House is access funding, but there's still a lot to allocate there. So definitely the message should be, and I'm sure Lev gives this message all the time, that we're kind of open for bids and open for ideas, and the Community-Led Housing Hub generates a lot of that, handles a lot of that interest, and brings great ideas to us all the time. I think what the GLA can offer, though, above and beyond its checkbook, is recognising that we probably do our best and kind of add the most value to the process, where we leverage our relationships across the public sector. So clearly we have relationships with every single borough. In fact, we have relationships with different departments, right? The planning department, the housing department, the environment department, the regen department, the community engagement team. So we are really keen to join the dots and bash heads together and tie things up where and whenever we can. And I'm really keen that we work in that way. So that, you know, that covers funders, landowners, developers, planning authorities, infrastructure providers. And I'm really pleased that Louise spent a good amount of time talking about housing associations. Those are our primary partners. And one of the things that really struck me in joining the GLA, we had a presentation from the regulator of social housing, who very tightly regulates that sector of registered providers of affordable housing. And the first thing they said to us pretty much in their presentation was, we exist to make this sector investable to capital markets. That's our job. We make this an investment worthy sector. And so, you know, credit where credit's due. On those terms, they have been successful, and that sector has grown, as Louise said, and attracted lots of capital, raised lots of debt at low cost. And I mean, it's, you know, we should definitely celebrate that we do in this country have a massive not-for-profit development industry for affordable housing, who are the housing associations and registered providers. They do come in for criticism somewhat, and I think it's worth thinking though that for the GLA, they're our most familiar partners, and we know them, we know their people, and we do know the expertise they have. So I think if it's not, as Louise said, not necessarily about a financial relationship, but in terms of trying to piggyback, trying to pick freebies and pro bono support and just get under the skin of and learn from what housing associations are doing, I would definitely emphasize that as a takeaway for community-led housing groups on the call. So while we can use our relationships, we can use our funding, I just wanted to give a few examples of what we're doing and where we're trying to do things better, do things differently. So the GLA also owns a lot of London itself. We've inherited some of it and we've bought a bit more of it where we felt that's appropriate. So we funded the acquisition, for example, of a former hospital site in Haringey called St Anne's, which many people will know. We're just concluding the procurement of a development partner there, but within our acquisition, we kind of changed the terms of what had been the approved planning application, and we're seeking a development partner to bring forward a new planning application. And because we own the land, we can set the terms. That includes 50 homes that we're saying will be delivered through a community-led approach, and there'll be ownership and control of a community group in that aspect, that small aspect of a relatively large master plan within that part of Haringey. Another way in which we've used our finance, which I think is quite useful, and we've done it in an industrial context, but I'd be interested to know if we could do it in a residential, would be where there's a development that's kind of speculative, it's coming forward a few years, you know, it's in the pipeline, we funded it a few years before there are any occupiers. We ourselves might buy a lot of the space in advance, or we might agree to lease it, and then we have control over who the tenants might ultimately be. Now, I'm saying this in an industrial, commercial floor space context. But it, you know, from a developer's point of view, that de-risks a lot of the development, right? They don't have to wait a few years to see who might be their tenants. The GLA has already said, look, we'll take half the space in this development, and then a few years down the line, we can weave that into our aspirations on economic development, regeneration, affordable workspace. We might be able to offer sub-market rents for a few years. Now, this stuff is easier to say than do. It's complex due to the kind of proper controls on best consideration and state aid and all that, but it's something that we're actively trying to explore more. And then in terms of how we might provide our finance, I think it's worth thinking when you're accessing funding from, or if you're able to access funding from the GLA or from a local authority or from a public sector partner, or indeed perhaps from like what I'm going to call a benevolent grant maker, I'm drawing a distinction where the grant maker is really interested in the outcome. It's a loan, perhaps it's not, you know, it's a commercial arrangement, but it really matters whether the thing that you're funding happens or not. And that's, you know, why a lot of organizations approach the GLA for funding. They know that we really care whether the outcome happens or not. And with community-led housing, we should be caring about how it happens as well. So I think there is a role for us, and it is something we're exploring, where we would provide finance for startup organizations that market lenders might view as really risky because they're small, they don't have much of a history, or as Dinah talked about, you know, their credit worthiness is not established. They might not have any assets as collateral. But if they're in a project where the GLA can have as its security the land or the project in development, or perhaps these are units, homes near to being finished, you know, if we can have like a real kind of stake and a real claim on the land and the development, if things went wrong, then, you know, we've got a real interest in making things right if they go wrong and bringing it forward. So I think if community-led groups come to us and say, look, we want you to do this, it's quite risky, but here's our plan B. You know, if we all weren't able to deliver this, the outcome could still be delivered by, you know, perhaps the local council or this housing association could step in and deliver it. And that would give us a lot more comfort about being in a more risky position. a few more remarks before I don't want to cut into anyone's time for questions. But I think, you know, we're on a journey ourselves in terms of understanding our own risk appetite. A lot of the tools and funds that we control are relatively new to London. The whole story of kind of housing being devolved to London is itself a journey that kind of starts in 2012, 2013 and is by no means over and by no means finished. There's probably a lot to come in the next few years about what powers we keep, what powers we gain, and dare I say, perhaps, you know, for some, they would advocate that we don't have the powers that we have at the moment. So understanding in the context of that devolution story, what is our risk appetite for being a lender as well as a grant maker is really interesting. I had back when we could have coffee with people, I had an interesting coffee with a colleague from a funder in a totally different sector. And she was saying, you know, we've just started issuing loans, whereas historically we've made hundreds of millions of pounds of grants, and everyone's really worried because they see loans as risky. Whereas we've just been giving out hundreds of millions of pounds and never asking for anything for it in the past. So that kind of, that's counterintuitive, but that does feel like kind of where we're in sometimes as the public sector, as a lender, as well as a grant maker. I would have some, I'd be interested to hear thoughts from the panel on recoverable grant, which is a term I hear more and more, which is a bit of a halfway house perhaps. So it matters because our finance and accounting colleagues need to understand how they account for money. So recoverable grant is, in our view, grant. So it's no longer our money, it's the counterparty's money, but there are provisions in that contract that we might, and we hope to, and indeed we might expect to get some or all of it back down the road. So in the past, I've heard people talk about kind of soft loans, which might be familiar. I don't know how comfortable I feel with that because I hate the whole soft hard distinction when it comes to outcomes or finance. That feels messy, but I think grant arrangements where there's some view in the future to get money back would be interesting. One thing that is promising is that some of the MHCLG money that we've recently been using in the land fund, we have made available as loans and grant. And although MHCLG gave us money in the first place, we may get it back. So we may have, don't hold your breath, but you know, we are trying to replenish our own resources. It's in our interest to do recoverable grant and to do loans, because then we get freedom to do more and more innovative stuff down the road that doesn't come with the initial constraints and conditions on which it's issued to the GLA. So yeah, I think my advice would be, you know, work with RPs where you can to piggyback on what they know and what they've learned and how that sector has emerged over 30 years. And then the other thing I think I wanted to leave you with, I'm really interested in the kind of community shares point and the crowdfunding point. One thing that's interesting on that is it's kind of proof of concept of your project in terms of community support, in terms of who would be, you know, if people are willing to put in £10 or £100 or £1,000 into a community share, it shows really that the people put their money where their mouth is, and there's real interest in participating in the community-led housing project, in living in it, maybe in buying a home, or to be cynical, at least not objecting to the planning application, right? So one thing that I've written down, I'm conscious to get across, which I think I'd be really keen, it would make my job easier, I'd be really keen for people to articulate is, yes, community-led housing is always going to have an element of risk. These are small startup organizations, but you know, breaking down risk into the different stages of development. So there's governance and setup of the organization, which is risky in any new organization. Then there's land acquisition or acquiring a controlling interest or an interest in a piece of land. Then there's planning. Planning is its own whole area of risk. And then development and construction itself is risky. And then sales are risky. You know, getting tenants and rents has an element of risk. And then long-term management and liability for, you know, all of those are their own risk categories. So when we think about community-led housing as being, you know, risky, are there subcategories of that where actually a community-led housing group could present itself to a funder and say, well, yeah, okay, you know, we're not, you know, Berkeley Homes, so we're not going to have this balance sheet, but on the planning side, we've got this, you know, on the management side, we've actually got this agreed already. And, you know, on sales, here's proof of these people have put into a community share offer. So that breakdown of risk would help, I think, funders and organizations themselves understand where they sit in their efforts to achieve the funding they need to make the projects they want to take place. Leave it there.
Thank you, Jonathan. That was wow, a whistle stop tour. I was actually going to, I know that there have been, I'm just sort of trying, I'm not doing it terribly well, but I'm trying to keep an eye on the questions. There's something that's come in from Stephen Hill that I'll call Stephen in a second. But before I do that, can I just ask one question? And Jonathan sort of raised it, but so I maybe can't put it back to him. But I think, I mean, it's one of the things from RUSS's point of view that we're very conscious that we need, you know, grant is really important because of those gaps to fill the way in which we're getting money, for instance, from Triodos. But actually, over time, we end up building on our financial modelling. We end up building up quite a substantial cash reserve, and it would feel sensible, therefore, that grant is then, as Jonathan's just touched on, really, that grant is then recovered and then reused within the terms of sort of community-led mutual support. I think maybe it's a question for Louise. I don't know. Just thinking on the legal side of things, what would we need to be doing, therefore, to recognise that income is set aside for that recovery from the off? Because I'm very conscious, for instance, of a lot. Well, I think you mentioned it yourself. A lot of the housing associations who now have very high balance sheets figures, you know, very, very strong organisations, they're sitting on 100% grant funded stock from the off. Now, okay, they have a recycled, you know, if they sell a property, they have to recycle that money. But actually, it's the fact that they were given grant, they borrowed a mortgage for 10, 20 years, 30 years, whatever it might have been, and those properties are now mortgage free. How would we build that in legally in the off, so that Jonathan perhaps and GLA could be comfortable, and then Mark or subordinated debt could be borrowed at a much lower percentage, which would then mean that we could you know, borrow more to do more.
Thanks, Dinah. That's a tricky one. And actually, in some ways, I think it's, as much as anything else, it's about it's an accounting question. I'm trying to dodge the bullet here, but I think there's an element of actually how do you account for it? How do you account for the grants in your balance sheet? I think that's one side of it. Grant agreements, I suppose, and you know, I think it's about, as Jonathan was saying, it's about thinking up front as to whether or not you want that grant back at some point, and making sure that that's built into the grant agreement at the outset, so that it's clear for both the entity and the lenders and funders, and also the body giving the grant. So I think clarity within the legal agreement up front is quite important. And I mean, I suppose you know, when you look at the housing association world, yeah, they are sitting on a lot of assets, and that's one of the big criticisms they come in for, particularly the smaller ones who or smaller to medium sized ones who maybe aren't developing, so they have got that vast amount of grant sitting, if you like, sort of equity sitting on their balance sheets, and that's what the regulator, another job that the regulator is trying to do. You know, it's interesting, Jonathan was talking about it, sort of them trying to make it an investable sector, and that really is the drive they have, but they are also trying to make them, and I think that the phrase they used a few years ago was sweat their assets. So there's a huge amount of pressure on them to not just be sitting on it, but to be using that and recycling it. And it's a very, I suppose it's an informal way of recycling. It's not a very formal process. It's just them saying, actually use that asset and recycle it and use it to raise more debt and build more. But I think that's, you know, there are legal issues around doing that, I think, when you're talking about a community owned investment that are slightly different to a housing association and the way they manage it through a regulated system. So sorry, that's probably not a very simple or straightforward answer. I think there's some legal things to think about, and there isn't a straightforward answer there.
Okay, I was actually just going to pass that over to Mark, because I know he and I have had some conversations about this, that what we would want to be trying to avoid is that the GLA lawyers get too worked up about how that is written, so that at least what is written is acceptable from the bank's point of view. I didn't know whether you wanted to say anything more about that, Mark.
Yeah, I mean, it's interesting. And Louise mentioned the accounting way of dealing with grants. And typically what you see is the grant is sits as a sort of a long-term liability, and then it's kind of written off in the accounts over 10, 15, 20 years. So they kind of put it into the P&L as a sort of a non-cash item, and they write it off like that. So that's the usual way of dealing with that. I'm not an accountant, by the way, so you need to get more details, but that's how I normally see those kind of grants being written off over a period of time. I think with the whole grant side of things, it does come down to the terms of the grant, as Louise again said. And certainly with Homes England and also GLA grants, there is a bit of a sting in the tail for banks. And that's hopefully something that would never actually happen, but in a distress situation where a bank has to try and recover its debt, there's a clawback provision in there. So the grant can be clawed back on that kind of disposal. And actually that does distort things slightly when we're looking at it at the front end, because the valuation that we thought we have, you've always got to allow for the fact that some of that could be pulled back. So that's one of the things that not a lot of people tend to think about. They think, oh, it's nice, it's got this grant, etc., etc. But from a funder's perspective, it's something that needs to be considered. Beyond that, I mean, the grants are pretty good, really. I mean, they're helping deliver a lot of projects that wouldn't have done otherwise. And from our perspective, it's a huge bonus when we're looking at it, but we do have to be mindful that there is that situation. But I think interestingly, I mean, picking up on the other point that Dinah mentioned there about cash surpluses, and it's quite funny actually, a lot of CLTs when I look at it struggle in the first 5 or 10 years, and then all of a sudden they start to build up this cash. And really, from a bank's perspective, it's kind of your money, unless there's some sort of requirement within the front end underwriting that the cash has to be retained or whatever. So it'd be interesting to see it being recycled in some shape or form or another. But quite how that will be done, it's almost like there needs to be some sort of central point that cash could be then chucked into a bucket, which can then be made use of slightly further down the line. But quite how that will be done, I don't know. But from a bank's perspective, as long as, you know, if I'm looking at it, as long as the organisation is capable of funding its debt and meeting any covenants on repayment, then actually that cash, yeah, it's kind of yours. I mean, I think obviously you'd need to be, and I'm sure you would, sensible that you may have some unexpected costs down the line, but surplus over and above that, I see no reason why that couldn't be reinvested, I suppose, into the whole sector.
Okay, now I know Lev says we've got a couple of questions in the question box, but Stephen, you've raised something taking us back to the 1950s in the chat list, and also obviously the sort of history of the housing corporation itself in the 1960s and 70s in terms of funding. Do you want to just...
Yeah, I don't think I went quite back as far as the 50s.
Not you personally, of course.
No, but certainly when I first started in housing, local authorities had powers to give individual mortgages as well as block mortgages to organisations. But I think the point I was trying to make was in relation to what you might call the last mile of equity, that bit of equity that's seen as the additional risk. And when both Labour and then Conservative governments were very interested in trying to kind of get self and custom build going, the industry working groups working with government put together a proposal to the Treasury that the Treasury could fund that proportion of risk between what a lender would lend on a normal mortgage and would feel they would need to put on to a self-build mortgage. And it was accepted once the scheme was finished, was very, very low. In fact, far lower than many other forms of lending. But it was during the development process with the self-build mortgage, which was part of funding the development. And so you're actually talking about very small margins of risk on top of the normal loan. And no, the Treasury wouldn't even consider it really. And yet, you know, within a few years, we have Help to Buy, which is kind of the same thing, but it actually requires the government to put in hard money to cover the additional equity. Every property is its own individual transaction quirks. The risk considerations. Actually, if you can't redeem the equity loan that you've got from government, actually the payback and fees are quite penal. And yet the kind of consequences of putting all that money, I mean, we're talking about hundreds of millions of pounds, is absolutely minimal in terms of the kind of beneficial outputs you might expect. You know, it's helped keep the big builders afloat. You know, were they capitalist businesses or not? It seems not. They benefit a few people for a very short time, and then they inflate house prices generally, and that's, you know, quite well evidenced by the RICS and other people. Whereas you think that all we're asking for, in the sense what NACS bill we're really asking for, which is just an underwriting facility on a small portion of the loan to cover what's perceived to be the extra risk. And this is something that local authorities still have powers to do, as far as I understand. They can provide guarantees, they have powers of general competence, and they still have powers to give individual mortgages. So it feels as if there are some untapped opportunities here. And you know, the point I made in my comment is that the decision to underwrite in particular circumstances is entirely political. It's not economic, it's not technical. They chose to underwrite home ownership for reasons we understand well.
Thank you, Stephen. Lev, do you want to either ask whoever it is, or sorry, I can't see the list that you're talking about, so you or ask the question on their behalf?
I think some of it's been partially covered, but I could bring in David Levison, who was making a point about, again, kind of going back to his...
Thanks, Stephen.
If he's still there.
Ooh.
Don't know if we're...
I can't. Oh, there you go. David, hello. Oh.
Hello there. Sorry, just at the critical moment, my Wi-Fi went down. I'm sorry about that. I didn't realise that you were bringing people in live to this discussion. My question, Louise, to Louise, and hello, Louise, by the way, was about warranties, and because you mentioned local government warranties. And my recollection, going back to the day when local authority land was transferred, let's say to housing associations to build on, or through stock transfers, is that the nature of warranties that local authorities would provide, which lenders then relied upon, were essentially to ensure that the land would continue in use for social housing purposes in perpetuity, or for a period of time. I was actually wondering whether there might be a form of warranty that could stand up legally, that could be given by public owners of land, that land, you know, needs to be used for the benefit of a community, a specific community, or communities, and I wondered whether that might be a possibility. Thank you.
Hi, David. Nice to see you. Interesting point. I think you know, and you're right. And I think in what it in some ways helpful, I think, to have some form of warranty or some kind of requirement for land to be held in perpetuity for affordable housing or social housing, whatever purpose it is that it's coming over from the local authority. I suppose my only sort of other thought around that is that it potentially impacts on value. So if you look at the impact that had on the social housing sector, all that land that came over then was valued on the basis of its existing use value. So as in, it has to be used for social housing, and that is a lower value in the vast majority of places than you might otherwise get for an equivalent market value. So I think there would be an interesting sort of trade-off there between actually with that requirement, does that then actually decrease the value and possibly impact on the you know, on the value for the lenders, or does it actually help by it possibly ensuring that there's it's a less risky proposition if it's going to be used for affordable or social housing than it is for, say, market housing? And I suppose the other thing that I was thinking about, that the other sort of aspect of those kind of stock transfers that we've sort of been looking at is nominations agreements and rights. So to a certain extent, I think in a way Jonathan was perhaps sort of slightly talking about it. How do you sort of that idea of putting forward you know, the GLA saying, yes, well, we'll take this off you for a commercial space. Actually, what those transfer agreements that is, you know, we've got nominations agreements into those properties for our council waiting list. Well, actually, that gives some kind of comfort that there is going to be a rental income there, which then potentially helps. So it's rental income on an affordable basis. That sort of ties in with your point on the warranties, and would that sort of help? So sort of. Yes, I think it's worth exploring as an idea, but I don't know whether Mark's got a view as to whether that would help them from a funding point of view or not.
Yeah, I mean, it's quite interesting actually, because quite a bit of that is already covered quite often in the planning consent. When land, you know, when consent is given on land, usually typically within section 106, which says it can only be used for affordable housing. And actually, if you took it just as that, yes, it does have quite a negative impact on value, as Louise mentioned. I also, when I was chatting, mentioned mortgagee in possession, and quite often within the section 106, there is alongside the need for the units to only be for affordable housing, there is an agreement that a lender can, after doing various things, actually access open market value and sell properties on the open market if they need to. And that's certainly what we rely on. So we typically would get two valuations. One, an affordable housing value, so market value subject to tenancies, and then one, the open market. The other one is the open market side. Because the mortgage in possession gives the bank the ability to access that open market value, we can lend against that. And what we do is we actually build in, we call it like a cascade mechanism, which effectively says, yeah, if something happens to the CLT and they can't pay, or they're for whatever reason no longer going to be around, we would give a time period of 6 or 9 months to find another community housing organisation, an RP, or even the council to step in and take back the units and repay our debt, or step into the shoes and take on the debt. So that's what we kind of do, and it also gives the local authority some comfort that they're not just getting rid of land from a political side of things, that they could be challenged. Well, why did you dispose of that land that's had value of £2 million for nothing? There's something they can kind of pin their hat on. So it kind of captures that mechanism that you were talking about, but in a separate kind of way.
Could I come back, Lev, very briefly, just on Mark's point, because I wasn't thinking of a mechanism that in effect replicates section 106 for community-led housing, because that then does get us into difficulties with valuation territory. I was simply thinking of a legal mechanism through the provision of the warranty, if that's going to give the lender the comfort that they need for the security. but that land is clearly being transferred for the purposes of community-led housing, not to sort of, you know, replicate the kind of Section 106 model.
Can I come in on that, because I've got an example from the GLA's experience. So if you go into the covenants, the land title covenants on the parts of the South Bank which were transferred from the GLC to Coin Street, or what it was back then, it says right there, you know, this plot of land will be used for affordable housing, you know, delivered through this cooperative for local people. And interestingly, it also says, and if not, and if it's, you know, if it becomes a commercial development, or then you need to give the GLC a big slice, the majority slice of the income that you get from that. So it's kind of both and it's kind of future-proof and resilient, because sometimes plans might change, and, you know, it might be there's a community-led housing group out there that in 20 years decides it wants to have a Tesco Express on the corner, and that's a good thing for that business to do. And, you know, rather than kind of tear everything up and rewrite everything, kind of the genius of our legal friends is to write that stuff in advance so that it's resilient enough to deal with those kind of things. The other thing that comes to mind, just an idea I had while others have been talking on the same lines, is, you know, it'd be interesting to see that point on recoverable grant and whether the GLA would actually want its money back in 20 years if it turns out that the cash surpluses had accumulated. I'd be interested to know if anyone has experience with or had considered, you know, writing the local authority into that as the recipient. You know, local authorities already have a commuted sums fund for affordable housing that they gain primarily through the planning system, as we just talked about. But, you know, it demonstrate quite a nice partnership if actually a community group could commit and say, well, we'll take this grant, and rather than, you know, it's almost more awkward for the GLA to figure out what to do with it 20 years later. But the local authority, we presume, will always be there and will always have, you know, will always be have the statutory duty on homelessness and housing and have affordable housing sums to distribute locally. So that'd be an interesting one to explore.
That's really helpful. I mean, I think presumably the GLC and Coin Street is a typical example of the clawback thing that Mark and Louise were touching on, really. And, you know, I'm conscious of it for the Commission of New Towns, you know, all of the income that was raised through there. I'm conscious that we would really like to bring in some other questions, if that's okay, David, if we sort of say goodbye to your lovely room. We've got a question here from Owen Jarvis saying, are we only talking about underwriting community land trusts? And I think, I mean, from RUSS's perspective, absolutely not. It's about dealing with all sorts of community-led housing. There are slightly different issues, I imagine, when you're dealing with co-housing or co-ops. But we touched on co-ops a bit earlier, and as I said, there is a session on Wednesday afternoon that's more specifically regarding them. But I don't know whether anyone of the panel wanted to touch on that at all. I mean, Mark, generally your lending is to community land trust, isn't it?
Yeah, well, no. I mean, it's community housing in any shape or form, to be honest.
Okay.
So co-housing, housing co-ops, and CLTs. In fact, we will look at some private providers of affordable housing as well, but different animal altogether, obviously. But yeah, no, it's actually the community part of it, however that's actually termed, and you know, we lend to all those. In fact, I'm looking at projects for all three types at the moment.
Okay, and there's a question here from John Broom, is would the panel be able to comment on the implementation of the Social Value Act in relation, I guess, to sort of innovation in funding? I suspect, John, that's what you're talking about. Does anyone have a particular pithy comment that they want to raise? I mean, obviously, so my understanding of Social Value Act and the way that a lot of local authorities have interpreted it is very narrow and focused primarily on sort of employment opportunities. I don't know whether there are any.
I could offer something as a start, which is having spent quite a bit of time thinking about the Social Value Act when it came in because of the role I was doing before. Yeah, I think it's a bit of a shame or a lost opportunity that it's become about kind of procurement of employment outcomes. That doesn't feel like a proper pigeonhole. You know, it's much broader than that, obviously. So yeah, we need to advocate that it's more than that. But the other thing that we anticipated when myself and colleagues at the time when it first came in was, like other pieces of legislation, it gets its teeth partly through challenge and through court decisions and precedent. And actually, I can't quite believe I'm saying this on record, but it probably needs some people to challenge some decisions and successfully win their cases in order for everyone to understand where it's being applied and actually not being applied, which it is a legal requirement to apply it. So yeah, we need challengers and the courts to do justice to that. So I guess if any funders wanted to fund some pro bono, legal support for a community group to challenge it, that would probably be quite an effective mechanism.
Thanks, Jonathan. I'm not quite sure where that would go, but I mean, I think it's a very helpful piece of legislation to frame some of the social impact that's actually could be delivered through community-led housing. But it requires probably some co-production work with local authorities or with Solace or something to actually recognise that it actually can be part of the social impact elements are much broader than just employment. But I'll shush now because we've only got a little bit more time. And Robert Vizier, you are with us, and you I'm not going to read your question out. I'm going to let you ask it. If you can demute yourself.
Hello.
Hi.
Good afternoon. What question? I did pose several questions about the land lease.
I don't think we caught that. Can you repeat that?
Oh, sorry. I did ask several questions in the chat. You referred to what question?
Oh, so I suppose there was a point you were making about the mentions of aggregators and umbrella organisations. And
oh yes.
There's another question. Also, sorry to interrupt. There's another question about what would. There was a mention really early on, Mark, about standardising elements of community-led housing. How would that aggregation really work? Because one of the really interesting things about community-led housing is the real diversity that we see. So I don't know if that was something you wanted to touch on a bit or expand on.
Yes.
Robert, you want to just enlarge the question yourself than what you've written then?
Yes. Okay. Then an umbrella organization might help. I think the community initiatives because they're all laymen and they all have to invent the wheel again. And if you have an umbrella organization that helps them get on the right track, the risk of them of failure will reduce, I think, and it will be more. It can give guarantees for an investor or lender that they will succeed. I think that they can bring down the risk a lot. Yeah, Elizabeth was raising a finger.
I'd like to respond to that. We certainly, Robert, as part of the design of the land fund, the land investment fund, we envisaged it being a centrally held investment pot, but a regionally distributed amount of capital, not necessarily with the decision making being held regionally or locally, but certainly the support to the community group, both as applying to the fund as well as monitoring the spending, acknowledging that land is a very local issue and that repeating such that we do in the social investment space, a London-based investment fund. I mean, some are brilliant, CAF's great, but particularly land needed to be as close as possible to the community. So we envisaged, in this case, the excuse to use the land fund, you could do it with other funds, of course, for community-led housing, is how do you both use and build on existing market infrastructure when you're creating new market infrastructure to provide a legacy, both in terms of the funding vehicle that recycles, but then actually in our case, we envisaged actually payment going to those umbrella organizations for the insight and the work that they would do to make sure that land acquisitions were in keeping with the fund and the fund criteria. We thought that was very important.
Is it worth just quickly getting Mark Ogden's view then on, I mean, I think that the challenge in terms of the standardization question is each community is responding to their own issues locally. So what bits of standardization would you like to see from us?
Yeah, I guess, and as Robert said, not trying to reinvent the wheel every time. And I know it's difficult, and I accept that one of the joys actually of community-led housing is that they are all different, but some of them, there needs to be a common theme, I think, certainly around sort of financial models and an understanding of terminology. And community organisation, fully accept it, and volunteers, etc., etc. But all I'm thinking about is if you're trying to bring more funders in, the sort of the more standardised things are, the easier that is. I mean, a lot of the mainstream funders kind of stick everything into a computer and press a button. If it says yes, then it's great. If it doesn't, then they can't be bothered. Whereas smaller organisations like Triodos and Ecology and CAF, they've got the time to actually look at these things on an individual basis. But it sure as hell helps if you've got something that looks like a relatively standardized financial model, for instance, and everybody's talking about the same sort of thing and it's got the same sort of outputs. And I know the National CLT Network have tried to do this in the past and introduce a standard model. It's not always worked, and I still don't think it is. I mean, I know they've brought a new system in and they've paid licenses and things, but I know a lot of CLTs going, well, we don't like that, we're not using it. So we'll use ProVal instead, or whatever. So all of a sudden you've got people going off at different tangents, and you've still got people producing their own spreadsheets, which you then have to sort of work your way through and check to see what the formulas are and what they're doing, and is actually driving what you're expecting it to do. So just things like that, really. And terminology, standardizing terminology would help, except that you can't, it's not a one size fits all, and it never will be. But I think there is more that could be done.
Thank you very much. I think there's also, I mean, we in RUSS have had to produce information that looks different for the GLA to the way it needs to look for you and the bank. So I think there just has to be an acceptance that different organisations will. I mean, I hear this in the charity sector as well. That why don't funders, why don't some of the big funders have the same approach to funding, to grants, to charities? When you're doing pitches there, I'm not sure we'll ever square that circle. I'm going to hand back. There's quite a lot that's come through. I mean, Lorraine has been answering various questions. She's sort of provided some interesting information about local authorities in response to John Broom's question. And I think, I don't know how you're going to do it, Lev, in terms of pulling together the questions as well. So the chat has got quite a lot of self support, but within what I'm seeing coming through there. But can I hand back to you, Lev, to wrap us up?
Thank you, Dinah. Yeah, hopefully we've got the recording, and I think it captures the chat and the Q&A. If not, we'll try and copy those before we leave.
Yeah.
I think it's been a really interesting discussion. I just wanted to say thank you to everyone. Thank you to the panel, and for chairing, Dinah. We would like to continue this conversation, particularly around how we can kind of make this financing bit easier and simpler, because it is a real challenge that we're continuing to face. I think there's the simple ways of continuing that through social media, CLH London, or through email with us on our contact page, community-led-housing.london. Also, there were mentions of working with housing associations, so the kind of we've got sessions tomorrow morning about how what housing associations are looking for out of partnerships with community-led housing organisations, and that'll be an interesting one. And similarly, local authorities and what developers, what opportunities there might be for developers on Wednesday morning. So please, if you're able to check out some of those sessions tomorrow and Wednesday. If not, you can always catch them on the recordings. But for today, we just wanted to say thanks again to all the attendees for taking part and sticking around and inputting in all of your comments. One thing that I will just briefly mention, Liz, is if it's possible to share your report I don't know if you can put that on the chat, or maybe we can email people afterwards. I was trying to find it online and I couldn't find it easily. Maybe that should be Gary as well, but I just want to say thanks again. And if the audience was there, there will be a big round of applause right now. Thanks. Thank you very much.
All right. Thanks, everyone.
Thanks, everyone. Bye.